Good morning, everyone. So my goal this morning is to hopefully provide you with some take-home value and also give you an idea of some of the current trends that are happening in industrial development and investment. I'll give you a brief overview of what's going on nationally, and then we'll focus on California. We do business in Southern California and Northern California, so I'll try to bounce back between the two. And then dive a little bit deeper into e-commerce, last mile, reverse logistics, and then a brief overview of the capital markets. And then if we have time to then discuss the business climate that's been going on as it relates to the industrial space in California. So industrial logistics, without a doubt, during the last 5 to 7 years, we've seen a structural shift in our business. And I haven't seen that structural shift since seeing how global trade grew over the last 25 years and how it impacted the ports of Los Angeles. Because imports have a direct correlation to our business, the demand for industrial real estate, and that's e-commerce. E-commerce has dramatically changed our business, and what we're also seeing, and John and Jerry talked about it a little bit before, we're seeing an integration between industrial and retail. Another term you've probably heard of is called omni-channel. I sometimes say that we're in the retail business. A lot of our tenants are retailers or they're supplying retailers. So, and that's also been a real big shift. E-commerce has really changed our business. Me, as well as numerous other competitors, remain very bullish about our business because of e-commerce. And I'm sure you've just heard recently, Blackstone made an $18.8 billion acquisition, 179 million square feet, a portfolio that they once owned. And then you hear about Walmart and Amazon basically having, they're competing against each other over one-day delivery. So, these again are huge impacts and changes to our business that also, in my view, show that there's a lot of strength in our market and also a lot of confidence in our market that will continue to grow and be prosperous. So what I want to talk about right now is just give you guys, everyone, a real brief overview of the United States and the California market. So the United States market is about 14 billion square feet. You can see that the vacancy rates are 4.3%. These are all first quarter 2019. 281 million feet of construction under development. But if you look at that, that's less than 2% of the existing base. Completions, 33 million feet. Absorptions, 31 million feet. So what we've seen over the last 5 to 8 years, we've seen a very balanced market where demand has definitely outstripped supply. And what that's also turned into, we've seen tremendous rental rate growth in the infill markets. Then you dive down to Los Angeles, 1 billion square feet, only 6.8 million square feet under construction. So there again, why we're seeing double-digit rental rate growth in California. Inland Empire has been the darling of this cycle. Inland Empire has been building 25 to 30 million square feet a year, and it's getting absorbed at 25 to million square feet a year. So to give you an example on rental rates today, if you're going to find a 600,000-foot building in Ontario, and if you can find that, those rents will be in the mid-50s. When we started this cycle, they were probably in the high 30s or low 40s. East Bay has been another terrific market where you have 200 million square feet. The East Bay has basically been a recipient of two things. One, a lot of industrial space from 2008 to 2012 was converted into multifamily. So we lost an incredible amount of stock. But we're also seeing is a migration of tenants from Silicon Valley. These are tech users. These are people you wouldn't think that lease industrial space, but Google, Apple, Facebook, they've been taking a lot of industrial space in the market. And then something that the Alan Matkins report started to follow, the Central Valley. The Central Valley is also becoming a very important market. Overall, again, we have an equilibrium in the market. And that's really helped to keep rental rates up. Next here, just to show you some of the 10 largest markets here in the United States. And you can see, the absorption and the development, a consistent theme here on these markets. They're close to population bases. They have infrastructure. They have ports, airports, and also infill ports. So they have large rail yards. Something else that you'll see in these markets that, which sort of surprised me when I saw this, that, Detroit's building 7 million square feet. Pennsylvania, I-78, I-81 corridor, that is generally all e-commerce driven. That has been a very robust market. A lot of developers have moved into that market with a vigorous pace. This just gives you an idea of completions. Again, same sort of markets. What's on this slide that was not on the previous slide was Phoenix and Columbus. Again, very e-commerce related. And then something else that I found very interesting, some of these secondary markets that in previous cycles, I don't think you would see 5 or 7 million feet in Columbus and Cincinnati, Indianapolis, or Detroit. So all of a sudden, a lot of these secondary markets are getting a lot of looks, and I'll talk about that when I say looks from institutional investors. And I'll talk about that. And again, the theme is e-commerce that's driving a lot of this construction. And the second thing is they're logistic hubs. Philadelphia, close to population centers. A lot of people are starting to look into the Orlando market. So I want to talk about a few trends. I'm going to first start with multi-story warehouses. Will this be the last mile solution? Multi-story warehouses, they're very prevalent in Asia. You see them in Asia. You see multiple buildings in Asia that are 3 to 5 stories. To me, the biggest difference, though, is if you look at a truck in Asia, so this could be Singapore, Tokyo, you look at these trucks, they're not 53-foot containers. They're much smaller. So to me, I think that's one of the challenges that we have in multi-story warehouses. We are seeing it. There's a Prologis built a building in Seattle. There's a building under construction in Brooklyn and South San Francisco. That's really it. I'm going to say maybe that's 2 million square feet going on right now out of 14 billion square feet. So in my view, rents need to increase, and we need to see land values increase, because to build a 3-story project like some of these multi-story buildings that's 300,000 feet, it could cost you $150 a foot versus $40 a foot. So, and then I'd say the other thing with multi-story, what we haven't seen any of these assets sell. What is the appetite for institutional investors to buy this product type? Cold storage, which I don't have on this list, and I'll touch basis on it. Cold storage is becoming a very hot area in the industrial market right now. And again, a lot of that is driven by retail sales, online retail sales. Clear height, and I have 32, 36, 40 feet. When I started in this business, the tallest building that you would build is 32 feet. Today, we see buildings in excess of 500,000 feet that are 40-foot clear, and it's all about cubic volume. 2 years ago, you would see very few buildings at 500,000 feet at 40 clear. It's mostly 1 million square foot buildings. So the breakoff really is when you have a building over 300,000 feet, you want to be at 36 clear. You have a building today over 500,000 to 600,000 feet, 40 clear. But it also depends upon the market that you're building in. You don't necessarily have to build a 40-foot clear building in Vernon unless it's a cold storage building or in Santa Fe Springs. Then the next point, parking for e-commerce. E-commerce users use a tremendous amount of parking, sometimes 2 to 3 times more or even 6 times more than the average industrial user because of all the people that are in the building. Automation might change that, but today it's a growing need for industrial space, and when you design a building, you have to think about excess parking. Advanced manufacturing buildings and creative industrial. So we've seen a lot on creative industrial where you're taking industrial buildings and you're converting them to office. In Northern California, where we do a lot of business, we came up with this phrase, advanced manufacturing buildings. And what I really like to say, it's a warehouse building on steroid. We put in a ton of power. We put in a ton of glass. We put in indoor-outdoor patios. And why we're doing it is because it's that need for that user who basically wants to retain and recruit people for their buildings. But the other issue is that cities don't want to see warehouse buildings. So they want to see advanced manufacturing buildings. So in Northern California, we're seeing multiple cities basically say that you now need a conditional use permit for a warehouse building, but not an advanced manufacturing building. And creative industrial, in our view, it is office. It's 20 to 30% office, but again, it's providing an experience for that tenant inside so you as a business owner can hire and retain employees. Electric trucks. I definitely think they're going to be here. I think it's important for our environment. When I was in London earlier this summer, I saw my first UPS electric truck. We are actually pre-wiring truck loading docks right now for EV chargers for electric trucks. I think we're going to see more of that, and I think users will want to see the ability to have EV chargers for electric trucks. And then autonomous vehicles. I bring that up because when you think of distribution, industrial, and logistics, there's a transportation component. Transportation is a far greater cost component than the actual physical warehouse space. We're going to see autonomous vehicles, but I really think that's going to be more on the highways. Are we designing buildings for autonomous vehicles? We're not. But are we thinking about what are we going to do with these parking lots if you have a lot of autonomous vehicles? Are we going to convert them to park-like or amenity space? Or are we going to rent it out potentially to all these Uber autonomous vehicles that need a place to park? So these are some of the trends that are going on in our business right now. E-commerce. So as I mentioned earlier, e-commerce is creating a structural shift in the industrial and logistics business. In 2018, e-commerce users captured 61% of the total tenant base, and these are large tenants over, I think, 500,000 square feet. But you can see e-commerce 43%, logistics 18%. And the reason why logistics is tied into e-commerce, you have something called third-party logistic providers. And generally, these firms are servicing the retail industry amongst other firms, whether it could be a Nestle or General Mills. And then you have the manufacturing, food and beverage, technology, which is becoming more prevalent in Northern California, but that's also a big demand driver. So I share this slide, and this slide's about 2 years old, and I don't think it's probably a little bit difficult to see, but I bring this up because there is a convergence of logistics and technology. I think the industrial sector and the industrial space, we're far behind in technology compared to our office buildings where you have smart key systems, you have automated calls for if you have to service somewhere, if you have to service something in the building. But with e-commerce and logistics, we haven't seen this connection here, and we're starting to see it. And if I look at this list today, there are a lot of companies that are in place, but a lot of companies that are gone. And so what I see in our business going forward, that there's going to be an integration of the third-party logistic providers and someone who's doing some sort of supply chain technology or someone who's doing some sort of delivery. And we can talk about delivery that's coming up. So this is just an interesting side on e-commerce and why it impacts our business. $500 billion of sales last year. I don't know if you can see this lower left-hand, but e-commerce purchases in the first quarter represented 10.2% of retail sales. Online grocery purchases right now are 3% of grocery sales. So this is what's driving the demand for cold storage space. And then the whole delivery component. 30% of shoppers 38% of shoppers expect deliveries within 1 or 2 days. So that is also driving great demand in the industrial space. CBRE has a statistic that they came up with that every $1 billion in e-commerce sales represents 1.25 million square feet. So you can imagine that if these sales continue to grow, and let's say retail grows 1 to 2%, but e-commerce becomes 10 or 15%, as many predict that it will create great demand. I don't know if that's sustainable. I think these e-commerce companies, when I say e-commerce, that could be a Walmart or a Target or a Best Buy. I think they'll figure out a way to work smarter with less space. So I briefly touched about this. Of the 100 largest leases in 2018, 61% were e-commerce, 61 million square feet. Inland Empire, 20 of the largest leases, the majority of those are e-commerce. Developers are building larger buildings today. 10 years ago, you would maybe see 1 or 2 million square foot buildings that were built a year. Now it's 6 or 8, and there are probably 15 or 20 that are planned in the Inland Empire. So last mile. I've touched on this a little bit earlier. One-day delivery is extremely important, but last mile is also about reducing the drive cycle and also your costs. So what does that mean in the industrial and logistics space? Smaller buildings, central locations, infill locations, close to employment centers, close to population centers, close to single family and multifamily. So last mile has really created demand for smaller buildings where an Amazon would take 1 million square feet in the Inland Empire. It's not uncommon for them to take 30, 50, or 100,000 feet in the infill markets, whether Santa Fe Springs, Huntington Beach, Fremont, South San Francisco. They have higher parking requirements. They need grade level buildings, and they also need additional power. And then the other question, going back to the multi-story, will last mile drive additional multi-story demand? Some other e-commerce trends and strategies. So it's not all about last mile. It's partnering. So Nordstrom's and Walmart, they have a curbside pickup system. So retailers are getting smarter, and that's really the omni-channel that I'm talking about. Lockers at multifamily buildings. Kroger just did a partnership with Octago in order to get home delivery going. Walmart and Amazon have lockers. Then you have Amazon. If you've been to a Kohl's, they have Amazon drop-offs at Kohl's stores. And then you have the flex flow space warehouse sharing. The whole warehouse sharing concept, which in my view, it's a real sexy name for third-party logistics, but it works. And basically what you're trying to do there, if you're a warehouse owner, you're trying to give some of your space to some other company that'll lease it out. And then the whole shipping business, Deliver, Shipsy, Dark Store, all these urban delivery services are popping up. And that, again, is another e-commerce strategy. So my point here, e-commerce isn't all about industrial logistics. It can be other areas. So last mile, this is becoming an important factor in our business. And so really reverse logistics. So what reverse logistics means, you're returning a product from us being the end user to that retailer or to that warehouse. And again, it's all about time of when that return goes back to that location and then gets shipped out again, because there are really 3 alternatives for returns. 1 is you resell it, 2 is you discount it tremendously, or 3, you scrap it. And the retailers are trying to get rid of the third one. Returns during the holiday season, 20 to 25% of sales. It's staggering. Brick and mortar stores, they have 7 to 9%. So what's reverse logistics doing? You have to inspect that product. You have to look at damages. You have to document it. You have to repackage it. Yeah, then you bulk sale or dispose of it. So what it's doing, it's creating additional industrial demand. For a reverse logistics company, which are usually 3PLs, they need more space. They need more space for these goods to get repackaged, and then they also need to get them shipped out. The beneficiaries of reverse logistics are developers and third-party logistic providers. So briefly on capital markets, industrial yields continue to compress. There's a tremendous appetite for industrial right now. Industrial is the preferred property type in the United States. Canada and China and Singapore have been the major investors in industrial. China and Canada, each of them respectively alone, invested over $5 billion in the United States. And they're going to the markets that I mentioned, the large markets, LA, Dallas, Fort Worth, Chicago, Atlanta, and New York. Capital flows, in my view, have a much greater impact than the 10-year T-bill. If capital inflows into industrial slowdown, then I think we'll see a rise in cap rates. If you look at where the 10-year T-bill was in November, I think it was 320, 325. Now it's, 210? Cap rates really have not moved. Maybe they've moved down 10 or 15 basis points. So if we see capital inflows slow down, then I think it could impact our business. But right now, there's a deep buyer pool for core industrial. This just gives you a basic idea of cap rates. So you can see on the coast we're 4.5% to 5%. Really, Southern California, Northern California right now, you're at a 4% cap rate. That's on untrended rents. We've even seen some cap rates at 3.7 to 3.8 within the last 3 or 4 months. But what's happening is people are chasing yield right now. And so institutional investors are going to other markets. They're going to Phoenix, they're going to Reno, they're going to Salt Lake City, they're going to Orlando. So that's really been a big shift in our business that we've seen, that you're seeing people chase yield in other markets. Going back to cold storage, if you had a cold storage building in Southern California, that would probably trade at a 5 or 5.25 cap versus a core industrial building at a 4 cap. Just overall debt, there's so much debt out there for core and value add development. Debt funds are competing with money center banks on non-recourse construction financing. I think also the availability of debt and capital have compressed yields. I mentioned where cap rates are at 3.75 to 4.25. When we look at a development project right now, the returns are anywhere from a 4.75 to 5.5% return. So the comment is that developers are always optimistic. I would agree with that. But there's a 20% spread between your buy and your exit. Construction debt basically is 50 to 65, 66% loan to cost, LIBOR plus 260 to 325. That's on a non-recourse basis. Permanent debt right now is 10 years plus 160 to 170. So, again, the debt markets are also being very favorable to our space. So briefly on the business climate, split tax rolls is definitely coming down. I think next year, we're going to see it. It's going to be a ballot measure. Measure W was passed. Measure W basically was a 5-cent per square foot tax on stormwater quality control. Measure EE, I think from the latest that I read, it looks like, I just got back from Europe last night, but I believe Measure EE is not going to pass. So, what all these issues mean, that if you look at some of these measures, there's a disproportionate share that is being put on business owners. And as a developer, as an investor, as a landlord, that does give me concern that it might force other companies to make that decision to move out of California. CEQA is still a huge issue. We need CEQA reform here in California. I wholeheartedly believe as a developer that I should go through an environmental impact review process. I should do traffic studies. I should do greenhouse gas studies. I should do air quality studies, biological studies, and that's great. And if we have mitigations, we should be responsible and address it. The challenge that we have is there's so many extorters out there, for lack of a better word, and all they want to do is sue your project to get money. And the challenge is we don't have legislation in California right now, if they lose, that they'd have to reimburse you for your legal bills. So CEQA reform is a huge issue. Municipalities restricting logistic operations. I think we, as in the industrial space, need to do a better job that e-commerce, 3PL, reverse logistics, those groups provide good-paying jobs and high-paying jobs in certain areas. But also, in a typical industrial building, an e-commerce user will have twice as many people than your typical distribution user. So it's something I've seen in Northern California. I think it's also going to shift down here in Southern California. In closing, so again, structural shift in our space. I still remain optimistic. I like the demand-supply balance. We are not overbuilding right now. We are keeping up with demand. We're seeing rental rate increases. We're seeing a tremendous amount of capital flowing into our space. So I think what would give me concerns is if this tariff issue just blows out of proportion. What does that do to the imports coming into the port? What does that do with consumer demand? And really what I really look at is, e-commerce, imports, business inventory, GDP. That's what I focus on. So, it's hard for me to predict and to say what's going to happen with that. But for our space right now, what's going on with e-commerce, some of these other uses, I remain pretty optimistic over the next couple of years. So with that, thank you for the time.